Good morning, dear delegates. Thank you very much. And please, I would like to encourage you all to take your seats for this important session. My name is Hannah Wanjir Ryder. I'm the CEO of Development Reimagined. We're an African-led, African-owned international development consultancy. And we have a MOU with the African Union Commission, and it is our pleasure, on behalf of Development Reimagined, it's my pleasure to be moderating this discussion today on enhancing credit ratings in Africa, challenges, opportunities, and the path forward. The question of credit ratings came up a lot yesterday. The question of Africa risk, biases. The presidents and ministers talked about this in a lot of detail yesterday, and we also had references to it in the panels thereafter. I've been moderating discussions on credit ratings for at least 5 or 6 years, and it's very easy to get stuck in the weeds of the technicalities. It's also very easy to also sit up here and just talk about the problems rather than the solutions. And so I want to have a special debate today with this fantastic, incredible, diverse group of participants and panelists. I'm also an economist. I mentioned that yesterday. And I know also as an economist, I know we could use statistics to make whatever case we want to make, right? So again, we don't need to go into the statistics necessarily. But again, what I would like to do is really to talk about, to have our panelists really give us indications about what is being done, what can be done to enhance credit ratings in Africa. I mentioned that there's a few issues that I want us to discuss today. And I think we should have enough time if we are quite dynamic and so on these topics. The first issue I'd like us to kick off with to help our audience, ministers, government officials, and others, is really about methodology in terms of credit ratings. What has been done in terms of the methodologies of what can be improved with the methodologies on credit ratings in order to really better understand what's happening on the African continent, perhaps in comparison to or in relation to other countries. I think as an example, we saw African countries during COVID-19 take some very strong steps, very responsible steps, but at the same time, there was a different, and especially compared to the rest of the world, where there was a lot of irresponsibility in terms of dealing with COVID-19. But at the same time, there seemed to be a perception that Africa would not be addressing these things correctly. And also in terms of credit ratings, there were shifts down rather than up. How do we address this? And I'm going to put this question first to Aurélien and then to Liliane in terms of what kinds of steps in terms of methodology can be taken.
This is important to really focus on what is a credit rating first. It's the ability and willingness of an issuer, being a sovereign or any other issuer, to pay its debt. And it's just that, it's nothing else. At Moody's, and I think it's true as well for the other rating agencies, all our methodologies are public, available on our website. And we welcome these opportunities to continue to explain what is a rating, what we do, and why it's important to continue in that vein. This is why we welcome the creation of the new agency. For our methodology, we always look at them and do iteration when we think something needs to be embedded. So for example, there are two elements that I would like to stress. The globality of the rating scale. It's very important for us because investors across the world, they have a matrix that is really useful to calibrate the risk for them. So a B2 credit in Latin America, in Africa, East Asia, will be to be able to put into the portfolio that they want to build. It's also a signal for the banking system when they want to give loans. So the globality of the scale is very important. And the methodology through changes, for example, when there was the arrest string in 2011, we decided to modify the way we integrate political risk into our methodology. We do often request for comments for the investor community and even the issuers to comment on the proposal of change in our methodology. And then we implement the methodology and we, by iteration, I would say, improve or develop the methodologies. An important point also to signal is that methodologies for credit ratings are just the first step. It's more a framework for us to be consistent in our approach. So we think that some elements have the same effect. So for example, if you have a weak balance of payment, a country is exposed to a risk of balance of payment crisis. And therefore, the external vulnerability is something we have to look at. And so the methodologies, through all the question it asks, we are sure to have a consistent approach when we look at a particular credit. Now, the important element is that this is just the first step. We look at all information that is available. We don't say that our methodology captures all the situations, but we, through the rating committee where we discuss, or the analysis when we discuss the credit or the report that we publish, we mention some elements that are important for the positioning of the credit rating that may not be in the methodology. I'll stop there, but this is important. It's a continuous process to try to improve our methodologies.
Yeah, I think it's important that that we understand what the methodologies are, but also that maybe there's some steps that can be taken to continuously improve them from an African perspective as well. There may be some specificities. Liliane, would you say that there are some specificities, or yeah, what's your perspective on the methodology question?
So Aurélien said that methodology is a first step, but it is an important step because somehow it helps determine the rating, the way countries are assessed. We have been concerned about the methodologies, indeed, that credit rating agencies use, particularly the lack of incorporation of social indicators in credit rating assessments. Now, we've seen credit rating agencies increasingly look at governance-related indicators, look at the potential economic and social costs of climate change, for example, and their implications for credit worthiness. The problem is that these are inconsistently applied and they are not sufficient. Credit rating assessments remain largely focused on business-friendly policies, measures, leaving aside some of the longer-term human rights-based, gender-sensitive, SDG-related social and environmental indicators that could provide a more comprehensive and fairer picture of the development trajectory of a state. I've heard the discussion about productive investments, but if there's anything that we've learned from the COVID-19 pandemic, it is that the quality of and access to health, education, social protection systems, and the labor conditions in those sectors directly impact workforce productivity, labor supply, and could eventually lead to long-term loss of economic growth and of the worsening of debt problems down the road, which is why we really focus or emphasize the need to consistently incorporate social and human rights related indicators into the assessment. Thank you.
Dauda, I want to bring you in because you're all doing a lot of work with African governments to try to get them to engage more and with the credit rating agencies. How is that going, and what would you say are the key lessons learned from that in terms of really understanding these methodologies and even being able to challenge them in the way that Liliane, for example, has just done?
The reality is, of course, the methodologies are the type of sort of processes that the credit rating agencies are using to start the credit rating process. Of course, we can come back to what follows after. But what I want to say there is we have realized at Africa at least, but also with some of our partners, that there has been a lot of misunderstanding among all actors that are involved. It's not only credit rating agencies, but also among governments, but also other type of stakeholders. So what we felt was needed was to very much put in place an initiative, an approach that allows to, for those actors to engage constructively, understand each other, because a country cannot claim or actually sort of expect to have better ratings so long as they don't understand how the rating process works and how they can leverage the process and how they can make the most out of it and engage constructively and positively with the credit rating agencies. So what we did was to come up with an initiative that aims, it's a three-pronged initiative. First of all, an initiative that actually rely on setting up a web portal where we actually have a lot of information for government officials in Africa, whether it's on the credit rating methodologies, whether it's on the data that are needed, whether it is also on the countries variable that actually are used in those methodologies. I think we felt that that was important to allow countries to very much understand what's going on and how the credit rating agency does their work, and I think that has been very helpful. The second option, the second sort of part of the initiative was to put in place what we call a concilium of advisors. So it's a group of advisors that actually many of them are former senior executives from credit rating agencies that now work for our organization, Africa Catalyst and UNDP, and provide advice to African officials that are involved in the credit rating process. So what it means is we do have the opportunity to send those experts in the field so that they can have discussion and respond to questions, but also share insight that can be helpful as countries get ready to prepare themselves to the credit rating process or actually are already in the process of going through those ratings. A third part of the initiative was also to allow what we call the community of practice, is to, countries can learn very much a lot from their peers that have been successful in some sort of activity. So let's say in the credit ratings, I think it's always good to put in place actually those sort of convening where countries that have to learn about the process may learn from how other countries have successfully actually engaged into the process. So that's what we try to do by convening some regional workshops where government officials from various sort of institutions come up, whether it's from the Ministry of Finance, the central banks, and other, the debt management officers. They sit and discuss among themselves what has been successful, what has not been successful, how we can get better. I think that's very important because when we talked about methodologies also, what we have to keep in mind is, yes, it's first of all, the responsibility of credit rating agencies to come up with sound methodologies. But we also have to keep in mind that actually, even when they do so, the data that they use is not necessarily something that they elaborate themselves. It comes from the countries themselves. And the countries, it is their responsibility to make sure that the data is not only sound, but it is also available on a timely basis, and it's also very much accessible. If that's not the case, what you have is actually credit rating agencies relying on third parties to get that type of information that might not actually reflect the reality of the countries themselves. So this is something that definitely actually needs to be addressed. And I think that's also something that has proven to be actually, to have a sort of very important implications on the ability of African countries to get the right sort of rating, at least the rating that they're expecting.
I want to come back to this question on transparency shortly, but let me quickly just bring in Edgy here. Of course, APRM also works and convenes governments as well. You'll be having a credit rating, your annual credit rating annual credit ratings conference next week. And you also do reports on what the credit rating agencies have been doing across the continent, where things have gone up, where things have gone down, and so on. What's your perspective in terms of the methodologies and how those can be improved, and what role also the African Credit Rating Agency might have in driving up an improvement in methodologies?
I would briefly want to highlight the work that the APRM has been undertaking since 2017 in supporting African member states in the area of African credit, in the area of credit rating. So since receiving that mandate from the African Union Assembly, the APRM has conducted several studies and they've come up with a policy framework that was also eventually endorsed by the African Union Assembly. And this framework of support had different components, one of which is the advisory and research area of work, which we provide to member states, and we also assess the credit rating landscape in Africa. The report that we produce is a biannual report called the African Sovereign Credit Rating Outlook Report that has been, I think we are now on the 10th edition of that report. And what we have been doing so far was to put together, the rating actions that have been taken place on the continent during that first 6 months or second 6 months of the year. What are the drivers of the rating action? And we also make our own suggestions, recommendations at the end of it. That's one part of the work that we have been doing. The other part of the work is to convene different platforms for African countries to come together to peer learn and peer share their experiences, their challenges, and their potentials in terms of how they can navigate the space of credit rating. And one of which you just mentioned, Hannah, is African Credit Rating Conference, which we are convening in collaboration with AfriCatalyst, UNDP, and UNECA, which the first one is going to be the next week in Cape Town. When I come to the issues you mentioned about methodology, APRM has been on the forefront, mentioning and identifying accuracies in actions that has been given to many of African countries. We can mention some of the cases that were, that were stated in Kenya, South Africa, Ghana, and many other cases. And we issue opinions, describing why we think rating action is inaccurate and unfair. And we have engaged, rating agencies as well in that regard. They put forward their reasons as to why the rating actions have been taken, but we also pinpoint those issues. But the unfortunate part here, I should state, Hannah, is that many of African countries had their grievances about the rating actions. But unfortunately, Africa doesn't have any platform to take these grievances forward. They remain grievances, and they are not, we do not have a continental-wide regulatory framework. Even the local framework, which such as, some of the security exchange commissions do not have the mandate to oversee the work of credit rating agencies on the continent. So that has always been the challenge.
Let's come back to that question also on regulation, because it is something which sits up there. And again, it will be really interesting to see if that's an important next step for countries and governments to consider, or even at the AU level. But before we go to that in terms of next steps, I want to speak a bit more about this transparency question. And I think it's great that we have two credit rating agencies here on this platform. You're here to engage more. I think hopefully also learn from what African governments are saying and thinking, taking that back, but also inform about what you do as well. And that transparency, I think, is very important, and engagement, which again, our institutions are also pushing forward, as we've heard. But is there enough transparency from our side as governments, as African governments? Are there significant data gaps? What should we be doing more in terms of enhancing our own transparency in order to enhance our credit ratings? Trevor, let me put that question to you.
The issue around what governments should be doing is a very cardinal one, and you must look at it from two sides. Firstly, fundamentally, I think as African governments, we need to take responsibility as well as appreciate the fact that there's a lender on the other side. Our responsibility firstly comes from the issue of having to be able to consider what our internal issues are in-house when we have taken this borrowing. If you look at the issue right now, the 21 countries that are facing debt distress, and the number of factors that are speaking to why they're facing debt distress. They'll be talking around the issues of increased borrowing, high borrowing rates, reduction in export revenue, and the issue around the sluggish growth in the economies. But all these factors, if you really look at them, is that they boil down to an issue of fiscal management. If you're looking at the Eurobond borrowing, the first fundamental issue around Eurobond borrowing is that the resources that are borrowed must be invested into a productive sector. The second one is that the country must have the capacity to be able to generate a hard currency revenue to be able to pay it back. And this fiduciary responsibility sits squarely with the borrowing country. I'll give you an example of Zambia. 2014, they went into the capital market and borrowed $750 million. But what you do find is that there are a lot of areas where the funds were used for recurring expenditure, budget support. So initially, before they even started, it got to a point where they had failed in their fiduciary responsibility to be able to do this. At the time of borrowing, the credit rating for the country was a B+. The interest rate that they were paying was 5.25. It was beautiful. But in essence is that now when we get to a point of default, all the issues come around credit rating, the issue around the G20 framework, and the potential for repayment. So I think technically there's an issue where we must deal with our internal issues, which is an issue of having to speak to financial prudence. And that is the first one. But secondly is that you must also look at what issues would apply then. In terms of the credit rating, there are a number of factors that I think obviously are missing. Firstly, if you're looking at the African continent, is that their economies are relatively unique, is that they're slightly different for every country, but two issues come into play. The first one is speaking to the level of informality in our business space. 90% is SMEs or informal entities that are running this. And secondly is that the African continent has natural resources that are speaking to their future capacity to be able to meet repayment, that we must factor this into the play. And I think those are key issues that you must be able to look at. But every country is talking around domestic resource mobilization to be able to support this repayment. There are a number of issues that haven't worked around domestic resource mobilization. Firstly, we are driving an agenda where we are using FDI to drive growth. FDI is externalizing the resources, so we don't actually, we've given them all these incentives for them to come. So we don't have a tax revenue from there to speak to having to meet our debt repayment. And secondly is that 90% of that economy is of small and medium enterprises that are within our local, but are not formal, so they're not paying. But we haven't given them any incentive for them to become formal to drive that domestic resource mobilization. And I think those are cardinal issues that we must address. So in looking at the credit rating, it is important that you look at a holistic approach, is that the credit rating when it's on is not just the only challenge that we need to deal with for this methodology to work, is that you need to look at all the other factors that contribute towards this. I'll hold my thought there.
Right, thank you, Trevor. And your point reminds me of something,
See the skills that you've got.
because, you know, exactly your point on foreign direct investment, it's seen as a positive in some of the indicators that we are very open to business and we don't have taxes on foreign direct investment, but that constrains our domestic resource mobilization capacity. But it might be seen as a positive even by the credit rating agencies, but it's not necessarily a positive. So I just wonder how much of that, Benjamin, in terms of for Standard & Poor's, how much of these nuances are you able to be considering and thinking about in your approach and in your engagement with governments? What data are you collecting? Are you using data that is adapted to these situations? Do you have more localized offices now on the African continent? What kind of progress are you making in terms of being able to collect the right data from our countries?
So I think, you know, just taking it back to what Aurélien said at the start, that ratings, sovereign credit ratings have a very narrow focus. You know, so we're looking at these indicators, a lot of these ESG indicators, with the perspective of, does it help a government repay its debt, you know, its commercial obligations in time or on time and in full? So, you know, a part of an important part of that is to look at the data thoroughly. So we will run sort of 6 monthly surveillance trips. I mean, the surveillance is really constant, but you know, the meetings, thorough meetings with all of the governments, so the central bank, the Ministry of Finance, the Debt Management Office, the Ministry of Economy, if that's one separately, all of the major banks, the central bank, large corporations, private sector participants that don't fall under those categories, embassies, staff of other entities that sort of work with their country, but not necessarily based in a country. So we have the ability to cross-check and slice and dice a huge amount of data in a way that enables us to reach a quality decision at the end of the process. So to the extent that our methodology enables us to sort of capture these new developments, for example, you know, we also go through a process of constantly updating our methodology to incorporate new developments that we don't think at the moment fully capture, you know, the ability of this issuer to repay its debt. So, you know, we like to think that we don't always have specific lines in the criteria that address these things, but there is flexibility in the framework that we can use in order to be able to reflect the reality on the ground. So, you know, within that process, we have numerous touch points throughout the year in country. Right? So there'll be typically there'll be one large rating trip where we go and do all of these meetings in person. Maybe the second one, because we have 2 regulated reviews per year for all of our EMEA sovereigns, could be in person, or it could be you know, a remote exercise, depending on the location. We have a full staff team based in Johannesburg, and we're expanding that team as well. So we have an African presence, but it's not just the sovereign ratings that we do these trips for. It's the banks where we rate them. It's the corporates. So actually, cumulatively, we can have, you know, a very significant amount of time spent on the ground. And of course, we're always speaking to people on the ground. So we'd like to think that there's probably more that you see, for example, from, you know, IMF staff article visit, the team come in for, I don't know, a week, a year or something like that. And so we're probably having more touch points you know, in any year. So hopefully that addresses
Yes,
some of
yeah.
these.
Thanks
questions.
very much. I think that's really important for countries to know exactly the sort of peer discussions, but also engagement. That's these sorts of platforms are for. I want to move a little bit to the discussion around the new rating agency, African Credit Rating Agency. How's that going? And what can we expect to be different about the African Credit Rating Agency, EGI? Give us an update, please.
Thanks, Anna. The African Credit Rating Agency is one of the core mechanisms that are also envisioned in the policy framework that was approved in 2017. But operationalization came quite late. We had to conduct quite extensive scientific research to prove that there is a need for establishment of an African rating agency. And through that exercise, we've confirmed that there is a need and there is a market for African credit rating agency. And this is one listed very important and strategic institution for African Union to, to address concerns around credit risk, accuracy, and contextual aspects that we have all been asking for. So the African Credit Rating Agency aims to provide context-specific assessments and its methodology. We are in the process of developing the methodology of assessment, and we will be able to capture the nuances of the African economies, which have not been able to be captured in the rating methodology of the other credit rating agencies. Also, the rating agency aims to support domestic capital markets. I should mention here is that, African capital markets are quite shallow. 90% of our corporates are unrated. Also, 22 sovereign African countries are unrated to date. So there is quite, a huge market that can, support the growth of the African financial markets, and the African Credit Rating Agency aims to fill that gap.
Aurélien, how does Moody's approach the African Credit Rating Agency? Are you excited about it? Worried?
Yeah, of course. No,
What's the
but
perspective?
yeah, it's very important to understand that we welcome the different views and opinion, and I'm sure the new African Rating Agency will also help issuers or potential issuers to better understand what the credit is. So we and there are also, is to mention, across the world, in every region, there are rating agencies that also participate to a better market efficiency. There is one element that I would like to also mention, speaking about the rating and the difference of opinion. The importance of a credit rating, especially in the sovereign space, it's important if it's credible, meaning that it behaves like it's supposed to behave, meaning that it should indicate the probability of default. And this is important for us, and I'm sure the other rating agencies as well. We look at the performance of our ratings all the time. We have dedicated teams that look at default studies, look at regional sector performance of our ratings. And we published last October a report that looked at Africa sovereign ratings. And we see the performance are perfectly in line with other regions' ratings, being LATAM, APAC, CEE, Central Eastern Europe, and CIS countries. A B2 in Africa has exactly the same evolution and a B2 in other regions. And so, as far as we're concerned, when we look at the data, even if the sample is small, there has been 10 defaults in that sample. they are really predictive of what has happened in the region, and this is absolutely key. So for us, there is no bias, as we heard a bit yesterday, in the use of the rating, in the predictability of the default of the rating, which is important. A rating ultimately needs to reflect a loss if there is a default. Otherwise, it's just you know, a rating that floats, but will lose rapidly its credibility.
Some of the points, Aurélien, you're mentioning, and I think also what Trevor was mentioning, are really kind of fundamental around the structures of how things, how our economies work and how we use debt, you know, for productivity or for current expenditure. Liliane, I want to come to you in terms of next steps, and I just also get the audience ready. We will do some Q&A shortly, but I just want to make sure we have a little bit more suggestions in terms of next steps. We're meant to talk about the path forward in this session. So, Liliane, what do you feel is the path forward? You talked about gaps that need to be addressed, and we've also heard about some progress that is being made within the credit rating agencies existing and also the new one, also progress by governments. Is there anything else that's necessary from your perspective?
Yes, thank you. So in Africa, particularly, we, of course, like others, we welcome the establishment of the African Credit Rating Agency. I think the concern perhaps is that the focus has really been on the methodology and the fact that, you know, it is hoped that this new credit rating agency is going to complement methodologies that are existing, offering a more context-specific assessment. I think it's important for that particular agency not to replicate or to avoid the pitfalls of existing agency. And for us, 3 key principles or core values should be observed by this credit agency, and that's transparency, participation, and accountability. You mentioned transparency in passing, but transparency allows more scrutiny, you know, and also enable participation of citizens, parliamentarians, and other concerned party in the assessment. Accountability is equally important. You know, what happened when a credit rating agency which provides opinions, which means they're really not, you know, accountable. What happens when this credit agency then has overly optimistic opinion, which leads to overborrowing, which eventually leads to debt crisis, which impedes on the state's ability to pay nurses, doctors, teachers, and then impacts on human rights? Where do citizens, parliamentarians, and others go to hold that credit rating agency? For us, it's important that there is regulation, monitoring of the functioning of APRM. And I heard discussions around the establishment of a possible debt management or monitoring mechanism at the AU level. I think we would want to see whether there is that particular element of monitoring of credit rating agency included or incorporated into that mechanism. And of course, you know, we would like to see other, you know, how the monitoring by other bodies and African states, you know, occurs in that context.
Right. Yes, Dauda, you know, the EU has got regulations, for example, on credit rating agencies, you know, requiring them to have local offices and certain types of reporting back. Is this something that comes up in your discussions with governments, and whether this is something that governments will actually do on the continent?
Well, Anna, I think this is a very important issue. I think it's the issue about how to go from here with this whole issue. I think everyone agrees that there is some work that credit rating agencies need to do in terms of improving their methodologies, but making it more transparent. And I think there has been some progress on that. Everyone also knows we are talking about methodology, but that's not enough. There is also a whole process, which if you know that the analysts, the credit rating agencies analysts who come to the countries, of course, is going to apply the methodology that the credit rating agency has set up. But the ultimate decision is not going to be based on that methodology and that analysis only. It's going to be actually taken by a credit rating committee within the institution. That needs also to be addressed. How to make sure that the sort of majority voting that is taken at that level actually is done in a way that is, of course, not only objective, but also transparent. That's another issue also that needs to be addressed. We didn't talk about that. But I think we also have to keep in mind that the issue is not only about the credit ratings, it's about also our countries and our institutions. From our institution, I think the idea from the African Union to have an African credit rating agency is something that we hope is going to help. But of course, as Aurélien was saying, I think a credit rating agency can only be useful if it is credible and if it has the right governance framework. And I think we are looking forward to getting more information about how that agency is going to be structured. But we also have to keep in mind that even if you solve all the issues with credit ratings, that's not going to be enough. That's not a panacea, because Africa is facing a lot of issues that actually are impeding its ability to attract private capital. And the credit rating is just one part of a big puzzle. The other puzzle is what? I think we talked about it. If African countries are more successful in mobilizing domestic revenue, maybe, of course, it's clear that they would be having less need of raising external or foreign borrowing and financing, and that would be helpful. Second, you talked about the regulation. I think it's critical that on top of what is being done, that the African Union, along with domestic national governments, do have a right supervisory and regulatory framework for credit rating agencies. Back in 2009, when after the global financial crisis, the European Union came up with a big sort of reform of its architecture surrounding credit rating agencies. That's when they came up with the ESMA, which is the European Security and Market Authorities, that actually was tasked with making sure that they sort of harmonize the regulation and make sure that credit rating agencies evolve in a very strong regulatory framework. And I think that's been very helpful in addressing a number of issues, including the risk of malpractices by credit rating agencies. Africa needs to go along and try to see how best to do it in a way that is not necessarily actually, restrictive, but in a way that can allow to reduce the potential risk of malpractice. That's second. I think one last issue that I would want to say, and hopefully moving forward we can take into account, is I say that the credit rating issues is not a panacea. We have to look at it from the broader perspective of the global financial architecture. Before this event, before this panel, there was a very interesting discussion that was sort of being made by the parliamentarian. And I think one in the audience, I think he's from Mauritania, said that I guess we have to keep away from this thinking that borrowing or debt has to finance only profitable sort of investment. I think I fully agree. But the reality is, you are also forced, if you're an African country, to borrow for other purpose than just investment. Many African countries have seen their debt levels sort of increase after the COVID pandemic because they had to borrow to respond to the crisis. Many African countries have also seen actually high level of debt after the security shock they were facing. We have seen that. We have seen countries in Africa that are spending a double digit actually in terms of actually part of their budget that is allocated to security. Many countries also have to respond by borrowing more to respond to climate shocks. So what we are saying here is, I think you have to keep in mind that for those sort of spending that are more actually related to the global public goods, the global financial architecture should come with a response that would not push these countries to go to the market to mobilize funding to actually respond to those type of shocks that are more actually, sort of the responsibility not only of African countries, but the whole global community. I think this is a critical issue. It puts on the table the issue about the reform of the global financial architecture. Maybe we need to look at it from a more holistic approach.
From a former ED for the IMF, I think you're pointing to questions like, the ability of African countries to get IMF SDRs, quotas, etc. All of those things would actually create a more enabling environment in order to be going to credit rating, to be able to go to the markets for credit that would be rated by the credit rating agencies for more specific things as opposed to general use, which we are constrained in lots of different ways. So thanks for that, Dauda. I think it's important. Again, also even for the credit rating agencies to understand the constraints that African countries are in compared to the rest of the world. I want to open up to the audience. I would like to suggest some questions. We'll take 3 questions at a time, and then we'll ask our panelists to, if your question is directed at one of the panelists, please say so. Please introduce yourself as well, and then we'll come to you. So we have a question here, straight up, another one there, and then another one here, please. And then we'll be first on the next one.
Okay, thank you. Je suis le docteur Koum.
My name is Koum Serge from Cameroon's Finance Ministry delegation. As we all know, African economies are highly dominated by informal sector and mainly the tertiary sector. And these economies' growth are also borne by the private sector. And we can even acknowledge that a part of financial resources are not captured by our government. How, at your level, do you succeed in capturing these variables in your various financial quotations or notations that you do at times, knowing that it's part of the economic health of a government? My second question goes to the standard representative. We noticed that many rating agencies give many notes or grades to the same countries. Why such a discrepancy? Can't we harmonize a methodology when it comes to notation or grades? Thank you. Yes, the second question.
From Cameroon, if you allow. Madame la modératrice, merci.
Thank you, Madam Moderator. This is another intervention from Cameroon. In order to improve credit rating in Africa, some rating agencies propose rating in local currency, knowing that our debt are not calculated in local currencies. So we are here thinking about we are talking about those agencies. What could be the impact of such ratings in local currencies on Africa's debt?
From here, over there, please. Please wait for your mic.
Thank you very much. I am Joseph Tula, Deputy Director of Public Debt Management in Sierra Leone. I hold a view, and this view is that the problem of our debt challenges is not the public debt management issue. It's bad debt. In the sense that, take a look at our SOEs. Most of them will take loans for which we follow what we call the principles of good debt management. We involve parliamentarians, we follow whatever rules, fiscal rules, transparency have been enhanced to debt collection. We do a lot of things so that we can hold on to debt principle, in the sense that our duty is just to choose amongst the lines of borrowers, that which we can borrow with low cost and minimal risk. And also we put in issues to develop the domestic debt management. But what happens is that beyond that point, management issues, we've got a lot of debt that has gone bad due to implementation problems. And sometimes what happens is that we have very delayed what we call disbursement uptake, such that we pay penalties and it adds also to the debt service. I just want to ask Mr. Benjamin, I know in their rating system, they just look at, I might be wrong, macroeconomic situation, and then they come out with an opinion. do you take into consideration factors that affect what we call bad debt, issues that cause our debt to go bad? We don't realize the desired project outcome of our debt that we take from these creditors. Thank you very much.
Thank you. Okay, we're going to take those 3 questions and then we'll come back to the audience. I think a couple of our panelists should absolutely respond directly to them, but I'm also going to allow others like Trevor, you might also want to come in here to also respond. Let me ask Benjamin to go first, please.
Sure. Okay. Thank you very much for the question. So I think, the first one about issues of informality, I mean, the large informal sectors. I mean, we use, obviously, and we speak to governments about what their estimates on the informal sector are. How large is the informal sector as a proportion of an economy? But ultimately, this is where the importance of the definition of a rating comes in. It's about whether or not it supports the capacity for a country to repay its debt. So to the extent that the government is able to extract revenue from that informal sector, it's important for us to understand, right? And so efforts that you see in many different countries throughout the region at the moment to formalize the tax base, so that means bring out of the informal sector and into the formal sector a proportion of the population or a significant amount of business, could be important steps to supporting the underlying revenue base of a country. And that is a positive thing, we think, for the overall sort of development of improving a government's revenue base. So the second question, I mean, I think it was about methodology in terms of, echo also what Aurélien said earlier on, that, we have one scale and one methodology to rate all of the sovereigns that we have globally. And at S&P, we have 140, right? And so it's a relative ranking. And so it reflects a combination of fundamentals, which are included in our methodology, or criteria, as we call it. And that is transparent and open, publicly available. And, I'm happy to discuss any specific part of it rather than get into the details of each individual bit of the criteria right now, because I don't think we have enough time. So, happy to engage in that afterwards, but it's consistently applied across all sovereigns globally. So we have a credible rank ordering of sovereign ratings, in our universe that do what Aurélien said, what they're supposed to do. That a double B credit doesn't default as often as a single B credit. And so we backtest and backtest and backtest through the decades of history that we've got, and they are performing as they should. I didn't fully understand, I don't think, the question about local currency and foreign currency ratings. I don't know if anyone could let me know what that question actually was.
Is the question about the existence of local rating agencies and the difference between the ratings between our ratings and theirs?
So it wasn't local
currency. There's any implications when it's local currency that,
Local currency debt?
Yes.
Yeah.
Or local rating agencies?
Maybe it's the same.
I can answer.
Yeah.
Can answer this question.
Yes. So the question, I think, of the gentleman of the Cameroon that I understood is the existence of African rating agencies that rate local currency debt and that have ratings that are much higher than our ratings that are perceived as only speaking to foreign currency debt. And in fact, they are complementary. We know and we collaborate in panels with all the regional agencies. We believe that today, with the integration of financial market, it's difficult to justify a gap between the local currency rating and the foreign currency rating. It's based on empirical data. A country that defaults in local currency, generally, there is a contamination of the the foreign currency world and vice versa, except if one sector is protected. So, for example, in the case of Ghana, the country defaulted first in local currency and then in foreign currency. In the case of Zambia, the country defaulted in foreign currency, and then the common framework said we protect the local currency sector because it's too small to solve the issue. And so in the past, we had gaps between the local currencies and foreign currency rating at Moody's. And now it's very difficult to justify. You will have to have a clear separation between the two worlds. And there are not many examples left.
So maybe if I may add, actually, Hannah, I think there was some question here. I think what is really important moving forward is for African countries to have a clear strategy about how to improve their ratings. And to do so, you need to also have a clear strategy about how to better engage with credit ratings agencies, both, of course, the big three, as we talked about, but also domestic local credit rating agencies. This is important. Why? Because if you look at it, at the end, I think it was Ben who reminded us, what are credit rating doing? They're only providing an opinion on the capacity of countries to repay their debt on time and in full. So anything that you can do as a country to really enhance and strengthen that capacity is welcome. Whether it is, of course, by mobilizing more domestic revenues, whether it is by, of course, implementing prudent debt management, whether it is, of course, also ensuring debt transparency. I think this is critical. But for all of that to happen, you, of course, need to have a strong accountability framework, of course, with the involvement of parliamentarians, all of that, to make sure that this is happening. Because I think the issue of debt, bad debt that our colleagues was talking about is something that definitely can be addressed if you have a proper accountability mechanism. So all of that needs to be done and really taken into account. You also need to make sure that you have the right economic policy making, because at the end of the day, the agencies are going to look at the stance of your fiscal policy. They're going to look at, of course, your statistics, statistical capacity. All of that, I think, needs to be improved to make sure that ultimately you also have the right ratings and the good ratings. That's, of course, on the government side, but definitely there is scope for also agencies to do what they're doing right now, which is actually very much welcome. It used to be a couple of years ago, you would never hear actually credit rating agencies in the public domain talking about actually what they're doing. So there is actually something that is changing now. When we see Aurélien and Ben here, I think this is something that needs to be, of course, improved and, of course, sustain so that they can hear from stakeholders, not only governmental stakeholders, but also all the domestic health stakeholders, what they think should be done in improving their sort of approach, their processes. I think that can only serve them as an institution, but that can also serve actually the investors that rely on their work to make sure that they invest or they take their sort of investment decisions.
Absolutely. Thank you, Dauda. That's actually a very, very good point to close. I'm afraid we don't have any more times for questions. Overall, I want to say thank you very much to our esteemed panelists. You were all fantastic. Dauda's absolutely right. It's great to have credit rating agencies here to engage, not just for us to learn, but also, as I mentioned, for you guys to also learn too from what our experiences are. And I think I thank the panelists for really giving us some very bold points, but also very clear and concise. So thank you, and thank you for some great questions from the audience as well. So we look forward to even more progress on this topic as we go forward and addressing exactly the questions that the presidents and ministers were saying to us yesterday. How do we go forward? So thank you, everyone.